Welcome to Virtual Learning Network. Retail Banking Session 1 Introduction to Retail Banking. Topics to be covered under this: Introduction, main subsets of retail banking. In this we have intermediation services, payments services, consumer banking, retail banking as diversification tool, differences between retail banking, private banking and priority banking. Last but not the least, advantages of retail banking. First is retail banking. Retail banking is banking in which banking institutions execute transactions directly with consumers rather than corporations or other banks. Services offered include savings and transactional accounts, mortgages, personal loans, debit cards and credit cards. Retail banking is quite broad in nature. It refers to the dealing of commercial banks with individual customers, both on liabilities and asset sides of the balance sheet. Fixed, current, saving accounts on the liability side and mortgages, loans, example personal loan, housing loan, auto loan and educational loan on the asset side are the most significant of the products offered by banks. Retail banking refers to provision of banking services to individuals and small business where the financial institutions are dealing with large number of low value transactions. Retail banking can be divided up to into deposit banking, current account banking, loan business, security business. Retail banking business is characterized by a high number of customer relationships, a high reputation rate of identical customer processes, as well as by a large number of services rendered annually. Next topic we have main subsets of retail banking. In this, retail banks offer a range of services to individual customers and to also small businesses rather than to large companies and other banks. The services can include current accounts, saving accounts, investment advice and broking and loans and mortgages. Retail banks perform two very significant functions for customer. Firstly, they enable customers to bank their money securely, access it easily and conduct transactions. And secondly, they provide access to additional money to fund large purchases such as buying a home. In return for holding customer funds which they can then invest, banks pay customers interest. Now, traditionally, a retail bank provided number 1 intermediation services and number 2 payment services. First we have intermediation services. In this we have liquidity risk. The bank provide intermediation services like liquidity risk, default risk. Liquidity risk are consequence of issuing liabilities that is deposits which are largely repayable on demand or at a very short notice. Default risk, the main asset held by banks are advances, and default risk refers to the risk of the interest and or capital on these advances not being repaid. Now, how will we manage liquidity risk? Liquidity risk can be managed by two ways. Number one, reserve asset management. Number 2, liability management. Now, what is liquidity risk? Liquidity risk relates to the risk of the bank having insufficient funds to meet its cash outflow commitments. लिक्विडिटी रिस्क उस रिस्क को कहते हैं जो बैंक को कई बार हो जाती है, वो वाला जोखिम जिससे वो फंड्स आगे जाके पे ना कर पाए अपने कस्टमर्स को, अपने इन्वेस्टर्स को. Basically, there are two main strategies a bank can adopt to manage this problem. As I told, number 1 is reserve asset management. This necessitates a bank to hold a stock of liquid assets to protect the illiquid advances portfolio from a large outflow of funds. Number 2 is liability management. We can also manage liquidity risk through liability management, which involves a bank managing its liabilities to meet loan commitments or lost liquidity. One form that this could take is simply to adjust interest rate on its deposits. Next we have default risk. Banks can manage default risk in number of ways. Number 1, screening. Banks can minimize the risk of default for each individual loan by considering the purpose of the loan and the financial conditions of the borrower. Number 2, pooling. Banks can undertake a large number of small loans rather than a small number of large loans. This is an application of the law of large number to the loan portfolio, which reduces the variability of loan loss, so increasing the loss through default. Third one is diversification. We can also manage the default risk through diversification. Banks can diversify the loan portfolio by lending to a wide range of different types of borrowers. For example, a bank should lend to both individuals and businesses, and within lending to businesses, should lend to businesses in different industries. This has the effect of offsetting the firm-specific risk within the portfolio. Next is collateral. Banks can manage default risk through collateral method. Bank may ask for collateral. Collateral is basically a security. Security होती है जो कस्टमर आके बैंक में देते हैं बिफोर टेकिंग लोन लेने से पहले. So bank may ask for collateral to be provided by the borrower. If the loan then goes to default, then the bank is able to sell the collateral and so recover some or the entire loan. If in future period, अगर फ्यूचर में ऐसा होता है कि borrower is unable to pay the loan, borrower लोन नहीं पे कर पा रहा है, तो बैंक उसकी सिक्योरिटी बेच देती है और उससे जो मनी आता है वो उससे अपने लोन को रिकवर करती है. नेक्स्ट वन इज कैपिटल. Finally, a bank should hold capital. This provides a cushion against loss in the event of default losses, which protects depositors from its effects. Next we have subset of retail banking is payment services. Most retail banks also provide payment services. A payment service is an accounting procedure whereby transfer of ownership of certain assets are carried out in settlement of debts incurred. Basically, a payment service can be separated into 3 components. Number 1, a medium of exchange enabling customers to acquire goods. Number 2, a medium of payment defect payment for the goods acquired. Number 3, a temporary store of purchasing power, since income and expenditure are generally not synchronized. Next topic is consumer banking. Consumer banking is the provision of products and services to meet the financial needs of individuals with a steady and verifiable income flow. Today, retail banking sector is characterized by 3 characteristics. That is, consumer banking is characterized by 3 basic characteristics. Number 1, multiple products, like example, deposits, credit cards, insurance, investments, and securities. Second characteristic of consumer banking is multiple channels of distribution, like call center, branch, or internet. Next feature of consumer banking is multiple customer groups. Example, consumer, small businesses, and corporate. Retail banking as a diversification tool. Banks in the process of financial intermediation are confronted with various kinds of financial and non-financial risk. For example, credit, interest rate, foreign exchange rate, liquidity, equity price, commodity price, legal, regulatory, and reputational, etc. These risks are highly interdependent, and events that affect one area of risk can have ramifications for a range of other risk categories. Now, what is risk? Risk is the potentiality that both the expected and unexpected events may have as adverse impact on the bank's capital or earnings. It is the amount expected to be lost due to changes in credit quality resulting in default. We'll have in this types of financial risk. First type of financial risk is credit risk. Credit risk may be defined as the risk of default on the part of borrower. The lender always faces the risk of the counterparty not repaying the loan or not making the due payment in time. This uncertainty of repayment by the borrower is also known as default risk. So, credit risk को हम default risk भी कहते हैं. Credit risk वो रिस्क होता है जो borrower लोन लेकर पे नहीं कर पाता है, उस रिस्क को हम credit risk कहते हैं. Some of the commonly used methods to measure credit risk are ratio of non-performing advances to total advances, ratio of loan losses to bad debts reserve, ratio of loan losses to capital and reserves, ratio of loan loss provisions to impaired credit, ratio of bad debt provisions to total income. Non-performing advances basically NPA होते हैं जिनको हम नॉन परफॉर्मिंग एसेट्स कहते हैं. एक बैंक में नॉन परफॉर्मिंग एसेट उसे कहते हैं जब कोई बोरोवर एक लोन के प्रिंसिपल अमाउंट या फिर उसका इंटरेस्ट अमाउंट या फिर दोनों 90 डेज से ज़्यादा पे नहीं कर पा रहा है और डिफॉल्ट हो रहा है, उसको नॉन परफॉर्मिंग एसेट बोलते हैं. दैट इज नोन एज एनपीए और नॉन परफॉर्मिंग एसेट. नाउ following instruments and tools are used through which credit risk management are carried out. Number 1 is portfolio management and number 2 is loan review mechanism. Second type of financial risk is portfolio management. Market risk. Market risk may be defined as the possibility of loss to a bank caused by the changes in the market variables. It is the risk that the value of on or off balance sheet positions will be adversely affected by movements in equity and interest rate markets, currency exchange rates, and commodity prices. Market risk is the risk to the bank's earning and capital due to changes in the market level of interest rates or prices of securities or foreign exchange or equities. Market risk management provides a comprehensive and dynamic framework for measuring, monitoring, and managing liquidity, interest rate, foreign exchange, and equity as well. Next, we have the identification of future changes in economic conditions like economic industry overturns, market risk events, and liquidity conditions. This is the scenario analysis and stress testing which is used to assess areas of potential problems in a given portfolio. Market risk अब होता कैसे है? Market risk arises out of the dynamics of market forces which for the banking industry में suppose for example interest rate fluctuation, interest rate change हो रहा है, maturity mismatches, exchange rate fluctuations, exchange rate change हो रहा है. Exchange rate is basically the rate at which the currency is exchanged. Market competition in terms of services and products, changing customer preferences and requirements resulting in product obsolescence. Product obsolescence means product is outdated, coupled with changes national and international politico-economic scenario. Next type of financial risk is interest rate risk, that is IRR. The management of interest rate risk should be one of the critical components of market risk management in banks. Interest rate risk is the potential negative impact on the net interest income, and it refers to the vulnerability of an institution's financial condition to the movement in interest rates. Like changes in interest rate affect earnings, value of assets, it affects liability, off-sheet balance sheet items, and also cash flow. Hence, the objective of interest rate risk management is to maintain earnings, improve the ability to absorb potential loss, and to ensure adequacy of the compensation received for the risk taken and effect risk-return trade-off. Banks have laid down policies with regard to volume, minimum maturity, holding period, duration, stop loss, rating standards for classifying securities in the trading book. Now, interest rate risk are of various types like price risk. Price risk occurs when assets are sold before their stated maturities. For example, in the financial market, bond prices and yields are inversely related. Price risk is closely associated with the trading book, which is created for making profit out of short-term movements in interest rates. Next type of interest rate risk is reinvestment risk. Uncertainty with regard to interest rate at which the future cash flows could be reinvested is called reinvestment risk. For example, any mismatches in cash flow would expose the banks to variations in NII as the market interest rates move in different directions. Next type of interest rate risk is equity price risk. Equity price risk is the risk of loss in the value of banks' equity investments and equity derivative instruments arising out of change in equity prices. Next type of interest rate risk, that is IRR, is commodity price risk. The risk of loss in value of commodity held traded by the bank arising out of changes in prices, basis mismatch and forward price, etc. Next type of financial risk is operational risk. Operational risk in general is defined as any risk which is not categorized as market or credit risk, or the risk of loss arising from various types of human or technical error. It is also synonym with settlement or payment risk and business interruption, administrative and legal risk. Operational risk has some form of link between credit and market risk. An operational problem with a business transaction could trigger a credit or a market risk. For example, the most important type of operational risk involves breakdowns in internal controls and corporate governance. Such breakdowns can lead to financial loss through error, fraud, or failure to perform in a timely manner or cause the interest of the bank to be compromised. Now, the objective of operational risk management. Operational risk management means the factor which manages the operational risk. The objective of operational risk management is to reduce the expected operational losses, that focuses on systematic removal of operational risk and uses a set of key risk indicators to measure and control risk on a continuous basis. Ultimate objective of operational risk management is to enhance the shareholders' value by being ready for risk-based capital allocation. Now, Indian banks have so far not evolved any scientific methods for quantifying operational risk. In the absence of any sophisticated models, banks could evolve simple benchmark based on an aggregate measure of business activity such as gross revenue, fee income, operating cost, managed assets or total assets, or a combination of these variables. For example, at present, scientific measurement of operational risk has not been evolved. Hence, 20% charged on the capital funds is earmarked for operational risk. Next, we have differences between retail banking, private banking, and priority banking. First, we'll start with retail banking. Retail banking, typical mass market banking, in which individual customers use local branches of larger commercial banks. Services offered include saving accounts, checking accounts, mortgages, personal loans, debit and credit cards, and certificates of deposit, that is known as CDs. Retail banking aims to be the one-stop shop for as many financial services as possible on behalf of retail clients. Some retail banks have even made a push into investment services such as wealth management, brokerage accounts, private banking, retirement planning. While some of these ancillary services are outsourced to third parties, they often intertwine with core retail banking accounts like checking and savings to allow for easier transfers and maintenance. Private banking goes beyond managing investments to address a client's entire financial situation. Services include, for example, growing and protecting assets in the present, providing specialized financing solutions, planning retirement and passing wealth on to future generations. Next we have private banking. Private banking is banking, investment and other financial services provided by banks to private individuals whose invest sizable asset. The term private refers to customer service rendered on a more personal basis than in mass market retail banking, usually through dedicated bank advisors. Next we have priority banking. Priority banking is relatively new in the Indian context. In this form of banking, the bank identifies its priority customers, often customers with deposits above 1 lakh. However, this is different for each individual bank. And some special benefits are also provided to these first-class customers by the bank. For example, they don't have to wait in the queue for transactions. They are assigned client relationship managers to take care of all their banking needs. These customers can use bank premises for holding meetings, can access the internet free of cost, and several other benefits are also provided. The basic purpose of this form of banking is to make the experience of banking hassle-free and less time-consuming. Next topic we have is advantages of retail banking. Advantages. Retail banking has inherent advantages outweighing certain disadvantages. It has also certain disadvantages also, but despite of this fact, we will discuss certain advantages of retail banking. Advantages are analyzed from the resource angle and the asset angle. So we'll discuss the advantages of retail banking first from the resource angle. Number 1 is effective customer management. Effective customer relationship management with the retail customers built a strong customer base. This is a biggest advantage of retail banking. Number 2, increasing the subsidiary business. Retail banking increases the subsidiary business of the banks. Number 3, retail deposits are stable. Retail deposits are stable and constitute core deposits. Number 4, interest insensitive. Retail banking are interest insensitive and less bargaining for additional interest. Next one is low cost funds. Retail banking constitute low cost funds for the banks. Now we'll come with the advantages of retail banking from the asset side. From asset side, first advantage, the foremost important advantage is earn good profits. Bank can earn good profits by providing non-fund based or fee-based services without deploying their funds. Number 2, low risk. Consumer loans are presumed to be a low risk and NPA perception. Number 3, diversified portfolio. Diversified portfolio due to high customer base enables bank to reduce their dependence on few or single borrower. Next advantage from the asset side is it helps economic revival. Retail banking helps economic revival of the nation through increased production activity. Next advantage is it improves lifestyle. Retail banking improves lifestyle and fulfills aspirations of the people through affordable credit. Next one is innovative. Retail banking is innovative product development credit. Beside these advantages of retail banking from the asset side, there are certain other advantages also, like minimum marketing efforts. Retail banking involves minimum marketing efforts in a demand-driven economy. Next, can be retail banking results in better yield and improved bottom line for a bank. Last but not the least, retail banking is a good avenue for funds deployment. Here we have set of questions. Do it yourself. Thank you and have a nice day.
अभी आप ही को याद कर रहे थे हम।
आप इसको स्टॉप कर।
आज मेरा गला सूख गया तो बाय बाय।
ओके बाय। 1 मिनट इनका सेव करना। आपका सेव हो गया? नहीं हुआ? सेव हो गया। मैं अभी स्टॉप कर दूँगा।